500 ounces of silver. That number sounds modest. It sounds like the kind of quiet, cautious decision a prudent person makes and then sets aside, reassured by its very ordinariness. But I want you to stop, genuinely stop, and consider whether what you are holding is actually ordinary at all. Because there is something occurring beneath the surface of the global financial architecture right now, something the headlines have not yet named, something the consensus has not yet ratified, and something that transforms that modest stack of silver from a peripheral hedge into a front-row seat at one of the most consequential monetary realignments in a generation. History, that most unforgiving of teachers, has demonstrated with remarkable consistency that the most significant financial transitions do not arrive announced. They do not wait for institutional consensus. They do not pause courteously while economists debate their existence. They begin quietly, almost invisibly, at the structural foundations, in the behavior of capital, in the erosion of confidence, in the slow but irreversible repricing of what constitutes genuine value. And by the time the majority of participants recognize the transition for what it is, the most significant advantages of early positioning have already dissolved into the past. What is happening today is not a temporary rally. It is not the kind of sentiment-driven enthusiasm that periodically sweeps through commodities markets and exhausts itself within a quarter. What is forming now is something older, something more serious, something rooted not in emotion, but in arithmetic. For decades, governments across the developed world expanded their debt obligations under a collective assumption so widely shared it ceased to be examined. The assumption that interest rates would remain accommodative indefinitely, that liquidity could substitute for structural soundness, that monetary expansion carried no permanent consequences for the credibility of the currencies it produced. That assumption is now, quietly but unmistakably, being tested. The mathematics of debt behave predictably when rates rise. What appeared manageable at 2% becomes genuinely burdensome at 5%. Government interest service costs expand. Corporate refinancing flexibility contracts. Consumers whose purchasing power had already been quietly hollowed out by years of inflation find their remaining capacity to spend diminished further. And crucially, this is the part most observers still underweight. These pressures do not arrive simultaneously in a single dramatic event. They accumulate in layers, they compound across interconnected systems. They produce not collapse but something subtler and in many ways more dangerous, a slow, persistent weakening of the confidence that holds the entire structure together. Confidence is the load-bearing wall of the modern financial system. Strip away the technical language, the central bank projections, the quarterly earnings reports, and what remains beneath all of it is a shared belief, a belief that promises will be honored, that currencies will retain purchasing power, that institutions managing these systems remain competent and in control. When that belief remains intact, the system functions. When it begins eroding, even slightly, even gradually, behavior changes, institutions reallocate quietly, capital seeks protection before instability becomes visible. And certain assets that exist outside the architecture of institutional promises, begin attracting attention that no policy announcement produced and no central banker authorized. Silver sits precisely at that intersection, not because of speculation, not because of social media momentum or retail enthusiasm, or the kind of narrative-driven excitement that produces sharp moves followed by equally sharp reversals. Silver sits there because of something far more durable, because of what it actually is and what it actually does, independent of whatever any government chooses to print or any central bank chooses to promise. Consider the industrial dimension alone, because it is routinely underestimated even by investors who follow precious metals closely. The global transformation toward electrified infrastructure is not a political preference. It is an engineering reality already embedded in decades of capital commitments. Solar energy systems require silver. Electric vehicle platforms require silver. Advanced telecommunications infrastructure requires silver. Medical devices, defense applications, data processing systems, and the ever-expanding universe of precision manufacturing. All of it requires silver, and requires it in ways that cannot be easily substituted at scale without accepting meaningful performance degradation. This is not speculative demand. This is structural demand, baked into the technological architecture of the world being built around us in real time. And against that demand stands a supply picture that offers very little comfort to those who assume markets will simply produce more of whatever is needed. Silver mining is slow, it is capital intensive, it is subject to regulatory timelines that stretch across years, not quarters. Much of global silver production arrives as a byproduct of mining other metals, which means output cannot simply be accelerated in direct response to rising silver prices. The consequence is that imbalances between demand and supply do not resolve themselves quickly or smoothly. They accumulate beneath the surface of the market, invisible for long stretches, then suddenly and dramatically visible when repricing begins. This is the architecture of the opportunity forming right now. And it is not yet obvious. It is not yet comfortable. It does not yet carry the validation of institutional consensus or the reassurance of widespread media coverage, which is, of course, precisely the point. Because markets do not reward positioning after clarity arrives. They reward it before. And for those willing to understand the structural forces at work before the broader market catches up, that difference between early and late discount is everything. If this conversation is making you think differently about what is happening beneath the surface of global markets, then do not leave yet. Because what I'm going to share in the next part is the mechanism most investors never see until it is far too late, and understanding it could change how you think about your financial future permanently. Hit that subscribe button right now, because what follows is the part they never teach you in any classroom. There is a pattern in financial history so consistent, so reliably repeated across centuries and across cultures, that its recurrence ought to inspire not surprise, but recognition. Every era of excessive monetary expansion eventually produces the same consequence. Not immediately, not dramatically, not on a schedule that permits orderly adjustment, but inevitably in the form of a structural reassessment of what actually preserves value across time. The Roman debasement of the denarius, the continental currency collapse of the Revolutionary period, the Weimar inflation, the Bretton Woods breakdown of 1971, the emerging market crises of the 1990s, the global financial crisis of 2008. In each instance, the majority of participants remained confident in the prevailing system until the moment confidence itself became the variable under pressure. Then everything shifted, not slowly and gracefully, but abruptly, and with consequences that disproportionately rewarded those who had positioned early and disproportionately punished those who had waited for certainty. We are not living in an unprecedented moment. We are living in a moment whose outlines are deeply familiar to anyone who has studied monetary history without the distorting lens of contemporary assumption. The specifics differ, the technology differs, the institutional vocabulary differs, but the underlying dynamic, a system built on expanding promises encountering the structural limits of those promises, is as old as money itself, and the assets that have historically performed the function of monetary refuge during such periods are not complicated or exotic. They are simple, tangible, and physically scarce, which brings us back with renewed urgency to silver. What distinguishes the current environment from previous cycles is not the presence of debt. Debt has always existed, but the scale of interdependence that has developed across global financial systems during the extended period of monetary accommodation that followed 2008. Central banks in every major economy pursued historically unprecedented levels of liquidity injection. Interest rates were suppressed to levels that, by any historical standard, were artificial. Asset prices across nearly every category, equities, real estate, corporate bonds, speculative instruments, were lifted simultaneously by the same rising tide of monetary expansion. And investors, quite rationally, adjusted their behavior to reflect the environment they were actually living in. Risk-taking was rewarded. Patience was penalized. Conventional monetary prudence looked, for more than a decade, like unnecessary restraint. But here is what that extended cycle produced beneath its placid surface. It produced leverage, enormous, interconnected, system-wide leverage, corporate leverage dependent on cheap refinancing, government leverage dependent on low-interest service costs, consumer leverage dependent on asset price appreciation, maintaining the illusion of wealth, and leverage, whatever its short-term advantages, has a structural property that cannot be negotiated away. It amplifies both gains and losses, and it transforms manageable problems into systemic ones when conditions change. Conditions have changed. Interest rates have risen from historical anomalies towards something approaching normalcy, and the system built on the assumption of permanent anomaly is now experiencing the consequences of that adjustment. The corporate sector faces refinancing pressures it has not confronted in 15 years. Governments face interest service burdens that increasingly compete with every other spending priority. Consumers face a cost of living that has structurally reset upward, while wage growth has, for many, failed to keep pace. None of this is catastrophic in isolation, but systems are not collections of isolated variables. They are webs of interdependence, and when multiple nodes within a web experience stress simultaneously, the behavior of the entire system changes in ways that no individual component predicts. This is where silver's dual nature becomes not merely interesting, but genuinely important. At the precise moment when monetary uncertainty is rising, when confidence in debt-based financial instruments is being quietly but meaningfully tested, Silver also sits at the center of an industrial transformation with no historical precedent in its breadth and depth. The electrification of the global economy is not a projection, it is an ongoing commitment of physical capital across every major economy. And silver's role in that transformation, in solar panels, in electric motors, in the conductors carrying current through the infrastructure being built right now, means that demand is not dependent on investor sentiment, it is dependent on physics. Silver conducts electricity better than any other metal. That is not a marketing claim. That is a property of the periodic table, and no amount of monetary policy can alter it. The resulting dynamic is genuinely unusual. Most assets respond primarily to a single category of force. Bonds respond to interest rates and inflation expectations. Equities respond to growth expectations and earnings. Commodities respond primarily to industrial supply and demand cycles. Silver responds to all of these simultaneously, and adds to them the monetary dimension that activates during precisely those periods when confidence in conventional financial assets begins to weaken. This is not coincidence. It is the reflection of silver's unique position at the intersection of monetary history and industrial necessity. The size of the silver market relative to global capital flows magnifies this dynamic in ways that most investors genuinely underestimate. Global bond markets represent hundreds of trillions of dollars in outstanding obligations. Equity markets operate at comparable scale. The total global silver market, all of it, including all above-ground inventory and all annual production, is, by comparison, extraordinarily small. The consequence of that asymmetry is that silver does not require a massive reallocation of global capital to experience dramatic repricing. It requires only a modest shift at the margins of institutional behavior. When even a small percentage of capital that ordinarily resides in conventional financial instruments begins seeking monetary protection, the impact on a market as small as silver is disproportionately large. This is not wishful thinking. It is a mathematical consequence of relative scale. And the historical record confirms what the mathematics suggests. Silver does not move gradually once momentum develops. It moves in compressed, aggressive repricing episodes that feel, to those experiencing them in real time, almost disorienting in their speed. The periods of apparent stagnation, the years during which silver seems forgotten, overlooked, almost irrelevant, are not evidence of permanent underperformance. They are the accumulation phase. They are the period during which structural imbalances build beneath the surface while the market's attention remains directed elsewhere. And when those imbalances finally reach a scale that forces recognition, the repricing that follows reflects not just the immediate catalyst but the entirety of the accumulated pressure that preceded it. This is the moment that rewards patience combined with understanding, and punishes the investor who waited for certainty before acting. Let us speak plainly about something that the financial industry rarely addresses with the candor it deserves, because candor about psychological vulnerability is not particularly profitable for those selling certainty. The single greatest obstacle between most investors and sound long-term positioning is not lack of information. Information is now more abundant than at any point in human history. The obstacle is emotional architecture, the particular way human psychology responds to uncertainty, to volatility, to the discomfort of holding a conviction that has not yet been validated by consensus. We are wired, deeply and persistently, to seek social confirmation before committing to a position. In prehistoric terms, that instinct was adaptive. Survival often depended on following the group. But financial markets are environments where the group, precisely because it is the group, cannot consistently arrive first. By definition, when consensus forms around an opportunity, the opportunity has already substantially repriced. The investors who benefit are those who preceded the consensus, who held conviction through the period of uncertainty, through the conflicting narratives, through the volatility that made the position feel uncomfortable precisely because it was not yet confirmed. Silver, right now, sits in exactly that zone of productive discomfort. It has not yet achieved the kind of mainstream narrative validation that brings in the wave of late-stage retail enthusiasm. Analysts still disagree. Financial media still treats it as a peripheral story. Institutional coverage remains thin relative to the structural case that the fundamentals support. And this is not a warning sign. This is the characteristic appearance of an early-stage transition in a market that has not yet fully repriced. The discomfort is not evidence that the thesis is wrong. The discomfort is evidence that you are early. Understanding this distinction between discomfort as signal of error and discomfort as the natural texture of early positioning is one of the genuinely difficult cognitive achievements in investing. It requires separating the emotional experience of uncertainty from the intellectual assessment of structural conditions. It requires recognizing that volatility, the sharp moves higher, followed by unsettling reversals, is not contradiction. It is the mechanism through which markets discover new equilibria. And for those who can hold the structural understanding clearly, while the emotional pressure of volatility attempts to override it, major transitions offer advantages that no other market environment provides. Think carefully about what is actually occurring at the global level right now. The tension that defines this moment, the tension between tightening conditions that expose leverage and loosening conditions that accelerate currency debasement, is not a tension that resolves comfortably. Policymakers face genuine constraints that did not exist during the long expansionary cycle. They cannot simply inject liquidity indefinitely without further eroding confidence in the currencies being diluted. They cannot tighten aggressively without accelerating the exposure of leverage that accumulated during years of artificially low rates. The options available to them are genuinely constrained in ways they have not been in recent memory, and that constraint, that authentic narrowing of the policy space, is itself a signal of a system approaching an inflection. Physical assets with monetary histories do not wait for policymakers to announce that inflection. Capital moves in anticipation. It moves on the recognition of structural conditions rather than the confirmation of official narratives. And among physical assets with monetary histories, silver occupies a position that is, at this particular moment, unusually compelling. The industrial demand foundation provides support that is independent of investor sentiment. The monetary demand dimension activates precisely as monetary uncertainty intensifies. The supply constraints mean that market cannot easily respond to rising demand with rising production. And the relative smallness of the market means that even modest capital reallocation produces disproportionate price impact. Those who hold silver now are not, as the conventional framing would suggest, simply holding a commodity that might appreciate. They are holding an asset positioned at the convergence of multiple structural forces, monetary, industrial, supply side, and psychological, that are independently powerful and, in combination, genuinely unusual. History does not repeat with mechanical precision, but it does, as the observation commonly attributed to Mark Twain suggests, rhyme with remarkable fidelity. And the rhyme forming now has the cadence of transitions that, in previous iterations, rewarded those who recognized the structural change early and held their conviction through the period of public uncertainty that always precedes public recognition. What comes next will not be comfortable, it will not be linear, it will not arrive with the reassuring accompaniment of institutional consensus and media validation. It will produce moments of doubt, of volatility, of conflicting narratives that make conviction difficult. But conviction grounded in structural understanding is not the same as stubbornness. It is the reasoned refusal to allow short-term emotional pressure to override long-term structural assessment. And in environments like this one, environments where the foundations of the prevailing monetary order are being quietly but meaningfully tested, that distinction is everything. You came to this conversation perhaps thinking about 500 ounces of silver as a modest, sensible, somewhat cautious position. I hope you are leaving it with a different understanding, not of the specific number, not of a precise price target, but of what that position actually represents inside the broader structural transition now underway. Because the most important financial decisions are almost never made with complete certainty. They are made with structural understanding, with historical awareness, and with the intellectual honesty to recognize that the moment of maximum opportunity and the moment of maximum comfort are almost never the same moment. Now I want to hear from you, and I mean this genuinely. What is your read on the structural forces we discussed today? Are you watching the monetary foundations the same way? Are you positioned, or are you still waiting for the confirmation that history suggests arrives too late? Leave your answer in the comments below, because this community's collective thinking is sharper than any single perspective, and the conversation we build together here matters. And remember, this is for education and discussion only, not personal financial advice.